Thank you very much. As I'm looking to get set up here, it was quite an interesting end of the first session, and I think we're talking about ETFs and we're talking about CFDs, and it so happens that my topic today is risk and currency management in today's market. We are traditional CFD providers. I'm not sure if you are familiar with CMC, but it's something which I try to. I'm going to probably focus on a bit more the risk element of trading, investing, and perhaps maybe gambling also. Okay, so I'm just going to kick it off. This keeps us out of risk, actually. I mean, it's just a disclaimer from our company, which is something which we need to do from a compliance point of view. But anyway, trading 101, let's talk about risk. It's when I first got this slot, I was really worried because it's a morning slot, and I was hoping. I mean, it's quite a boring topic, and it's quite a slow topic because I'm sure most of you came here to talk about how to make money, how to score a goal, basically, and nobody wants to hear about risk. So I'm very happy that the SIAS people gave us this morning slot, because I hope that everybody's fresh now to be able to deal with some of this. Because nobody trades to lose, okay? But in fact, risk management is perhaps one of the most integral component of any trading strategy. It's like learning how to walk before you learn how to run. And in fact, I was just trying to think of how to talk about this and to lead this topic into this seminar today. And it came to me the last couple of days or the last couple of weeks. A good friend of mine, his name is Alex. A couple of weeks ago, I met him, and we were meeting on a casual basis outside, and he was actually in great mood. And I was wondering why. And so he basically said he kena, and I didn't know what he meant. Basically, he said he managed to get some IPO. Okay, so I said, great. China? He said, no, Singapore IPO. He managed to get some allocation for some IPO. So, I mean, his rationale, when I was talking to him further, he was basically talking and saying that, well, Singapore hasn't really had too many IPOs this year, so there's sort of a pent-up kind of demand building in, right? And that's, fair enough. I think it was a company called GCCP. So I asked him a bit of details. What do you get it at? He said the IPO price is 23. So basically, from my background, I'm a trader in the past. I spoke to him. I said, what's your plan? First thing he said, I think 30 cents I sell. Okay, and I said, when are you going to do that? Open up. I'm going to get rid of it now. If it goes during the day, if there's a chance, maybe I'll hold some. But he's looking at a target of around 30 cents. So I questioned him, what's your downside? What's your protection? What's your stop loss? Terms that most people, when they go into trading, and if they're trading from a long-term point of view, they more or less have in their DNA. Okay? So he said, 23 cents, downside 20 cents. Or maybe 20 and a half. Because once it breaks below 20 cents, you're going to see a different spread. So the rationale, perfect. You make half a cent, you lose 0.01%. Okay? Upside 30 cents, downside 20 cents. At the 23 cents, I mean, the risk reward looks good on paper. No? So last night I bumped into him again, and it so happened, and he wasn't that happy as he was the previous week. So I said, what happened? Because I don't follow this at all. He said, did you sell? He said, no. I said, what happened? He said, it opened at 19.1 or 19.2. Okay? So I said, so? I mean, you should have gotten rid of it. He said, what? My cut loss was 20 and a half. Okay? Now, he did nothing wrong in taking that stock or accepting that IPO. I mean, because he was going in for a gamble. And this is normal. Why? Because people trade to win, not trade to lose. But losing is a very real component in today's trading and investing and gambling. Okay? He had a plan. Number two, he had a plan. But the thing is that he didn't commit to that plan. Okay? And very often, in my 30 years, I met many people. I mean, I've been a trader, so I don't really talk about it. I trade and I talk to my colleagues about this, and we are trying to psychoanalyze each other. Why we didn't do this, why we did that. Okay? But the bottom line is, risk management is, I think, one of the most integral. In fact, it is the backbone. And we can talk about ETFs, we can talk about CFDs, we can talk about anything. But if you don't manage the risk, excuse me, I mean, you're not anywhere. Now, I'm just going to breeze through, I mean, I've got only 45 minutes. I'm going to cover 3 main topics, okay? I'm going to just talk about certain types of risks that you'll be, as a trader, investor, or gambler, or whatever, be faced with. You're going to look at, I'm going to also talk about the psychology of risk. And this is where I tend to come in a bigger way, because that's where I think has the most value in my trading plan, or the way I approach my strategies going forward. And then I'm going to, if I have a bit of time, introduce some basic techniques. These are basic, fundamental, I mean basic, and you know, we can obviously develop on that if we have more time, but I mean, I hope to introduce a few things to you guys down here. Now, types of trading and investment, types of risks in trading and investment, these are very simple. I'm just going to go through the definition of most of that. Market risk, business risk, credit risk, currency risk, interest rate risk, geopolitical risk. Okay, I mean, these are quite standard stuff. Market risk. This market risk, or otherwise known as bubble risk, okay, is just a chart of some Chinese airline stocks. Okay, now don't get me wrong, they are valued really cheaply, because all analyst reports you see, and if you see the valuations for some of these companies, they are mid-teens PE for some of the Chinese stocks. So they're not expensive at all. But the thing is, this move down here, okay, is a bubble-like move. It wasn't created because all of a sudden people realized the valuation is cheap. The valuation for the stock, everybody knew it even there, because nothing has changed in the business to warrant that sort of a move in that short of a time. Okay? So essentially, I'm looking at this as a bubble risk or market risk, meaning liquidity drove it up, and the pool of liquidity could also bring it back down. The question is this going to go up all the way here before it comes down, or even down here it's going to start to, you know, weaken? This chart was done, I mean, I did this about a week and a half ago. Today, some of them, I mean, like for China Southern, I mean, they've come down to around here. Looks like it may pop again on Monday, because we've got good numbers over the weekend from the US, and we've got a bit of risk on, if you may, okay, in the market. But this is just an example of market risk. Sembcorp Marine business risk, okay. I brought this up, I mean, not to talk about the company, but just to talk about what business risk is all about. So please be clear, I'm not recommending buy or sell. Business risk means the concentration of that company on a particular type of business. Okay, and we saw the business risk hurt them so badly this period, because everybody knows they do rig building, right? Rig building means that they are most geared to the upstream oil business, and upstream oil is geared towards the price of crude. Crude goes up, stocks like this will go up. Why? Because the rig builders, or rather the rig owners, will order rigs from them, because the rig owners can rent out rigs to the explorers or the different oil companies. Okay, business risk saw this collapse for the stock. It's now hovering here, looking to find a base. Oil has started to rebound slightly. Where we go from here, I mean, it remains to be seen. But this is, like I say, is just a highlight of business risk. Credit risk. It's a stock that I think everybody knows. Anybody can guess? I mean, there's a little bit of hint down there, basically. This is Noble. But you are seeing, you're not recognizing this chart, because the chart, it doesn't show an up. Everybody knows Noble at 80-something cents, because it has come down from, you know, 130 or so to this level. This is a chart of the CDS. CDS of Noble. CDS is the credit default swap. A big term that you all see in the papers. But basically what it means, very simple, is the insurance that creditors of Noble, people who borrow money from, people who lend money to Noble, how much is it costing them to insure the debt that they have outstanding, or the loans that they have outstanding to Noble? And you can see that credit risk has gone up for them. Okay, this is obviously at the start of iceberg. It went up, shot up, pulled back down because they had 1 or 2 revolving credits being rolled over. But I mean, this is again, I think early last week. It's now around here, okay? Not much of a difference, but it hasn't come down. Excuse me. What does that tell you? I mean, everybody out there in the papers, analysts write reports, Noble, $1.30 target. I mean, I saw one report the other day, or still good or whatever. Everybody's buy. I mean, if you look at the Bloomberg, almost That's fine. Everybody's focused on the stock price. Okay. If I were Noble's management, and I'm not, and I couldn't speak for them, I would be more concerned with my business. And my business has to deal with the people that I owe money to, the people that I borrow money to, the people that I seek credit lines from. If I were a banker of Noble, for example, or if I were a partner of Noble in terms of, a buyer or a seller in terms of the business, I may be a bit concerned. And if I were to pull down some of these credit lines, not necessarily say cancel, or maybe pull down, we may see Noble's business being questioned. And I'm not saying anything about Noble, please don't get me wrong. I know this for a fact, because I work for Lehman's, I work for Peregrine. And if you know Peregrine, 1976, I was right in the middle of the storm. And this was exactly what happened to us. Not because I was based in London then, okay? And it was fine, we were doing okay. But one portion of our business suffered a little bit of a problem, but we could make those commitments. But the word got out, bankers got nervous, they pulled lines, and the business evaporated overnight. And that caused a spiral in Asian financial crisis. Okay? Together with a lot of other things. I don't say that we started anything, but together with a whole bundle of other things. But I just wanted to give this as an example. Not, again, please don't get me wrong. It's about Noble. Sorry, it's not about Noble. It's about credit risk. Yeah, so I'm just lucky I showed the first thing. Okay, currency risk, just very briefly. Okay, this is just a screenshot. Again, 2 weeks ago. Things a week and a half ago. Things must have changed. I just want to draw your attention to this line. This is a year-to-date performances. Okay, these are some like Dow Jones, S&P, and these are some of the European index. The DAX, for example, which is a German index, at that point in time was up 20%. Wonderful. All the European markets shoot up or have shot up this year because of, everybody knows QE, Mr. Draghi, so on and so forth. But if you are a Singapore investor, and I'm sure most of you are, and you use a base currency of Singapore dollars, for example, your return to you would only be about 9%. About there, right? Yeah, 9%. Why? Even though the market is up 20%, your returns, because you are exposed to that currency risk. What happened in a period of time as German stocks moved up, like most of the European stocks moved up, we also saw the Singapore dollar lose in terms of currency strength versus the euro. As a result of that, there's a lot of slippage. And these are things that, as an investor, as a trader, or when you look at global stuff, you have to actually account for it, okay, as part of your plan. Interest rate risk is quite, I just wanted to show this as a chart to highlight. And it has everything to do with FOMC on one side, growth, no growth, good number, growth, more stimulus, so on and so forth. But interest rate risk can move currencies like that. And the last was geopolitical risk. I didn't have an example, but geopolitical includes things like, Greece, for example. A well-documented affair, still in the process of brinkmanship between Greece and the EU. But I just wanted to bring one highlight on here. The biggest risk when trading and investing, okay, is yourself. It's you and yourself alone. I say this purely because if you didn't get involved in anything, or my friend Alex, for example, if he didn't buy into something, okay, and buying is not wrong at all because he's looking for the opportunity, but he didn't manage his risk. And likewise, I've heard so many nice stories, but I hear more war stories in my career. Okay, the biggest risk is yourself, because it is you who get yourself into the position, because your broker asks you to buy, or suggests, or you read a report, and it tells you, okay, it looks like a good buy because this industry is shaping up, so on and so forth, or your brother-in-law give you a tip. Okay, but the thing is that once you are in it, or in a trade, in a position, okay, you are alone. You are lonely. Your broker or the journalist who wrote about this stock or this market or whatever, he or she is not going to come and say, I think it's time to get out. Or I think you should manage that position. It's you. It's you and you alone. And if you don't realize that, or you don't face up to that, it's always going to be a risk. Forget about whatever you can talk about. Oh yeah, it shouldn't have come out. The number was bad. I expected this. It's you. Okay? Alex could have gotten out. He would have lost money. at 19.5 or 19 whatever cents, right? He would have lost money. But the thing is that he would have lost less money because the stock GCCP, if I'm not mistaken, I didn't say this just now, it's around 13 cents or 12.5 cents. And this is in the 6 days or 7 days. Okay? Now, so understanding the psychology of risk, okay, is trying to be able to match your objectives and knowing yourself. Because there's no point in, at the end of it all, being an expert here and there on everything, on currency, on this market, on this stock, or whatever. I know, we know, this information is good, but if you don't manage that, you're nothing. Now, the second part, key objectives of investing, trading, is always been maximize profits. Okay, everybody that I met, I asked you, what's your objective? Make money. Very simple. They forget that capital preservation, okay, should be actually first. Like I mentioned at the very start, learning how to walk before you learn how to run. Okay, so it's something which I stress across very closely because defense is the new offense. I mean, it's a tagline. And this time I managed to pull this. I mean, it's not my football club, but still, I'm sure most of you are familiar, or some of you are familiar. For those who are familiar, Chelsea is one of the richest football clubs in the world. They recently won the EPL, okay? And they won it way before the end of the season. I think 3-4 games, with 3-4 games in play. But the key to their strategy was a good defensive strategy, consistent throughout that very long tournament. They were the team with the least losses and with the least number of goals that were let in. Okay? And you know what? They were criticized through the whole season. They are boring. There was a boring chance. I mean, there's some of this chance. And they were criticized by other fans. But they took it. And now, I mean, when everybody is still, I mean, they're still, trying to work out the other slots remaining, I mean, they're home free. Okay? So, nothing glamorous, but winners. I mean, the other example, I thought, I try to spend some time down here also. Manny and Floyd. Manny is the heart. Is the heart of all our support. Okay, and if you read a few things about last week's fight, I didn't have the privilege to see it, but everybody who saw it told me it's a boring game because Floyd was just running away from him, and Manny was just going for him. Okay, Manny is traditionally a very strong attacking boxer. Floyd, on the other hand, strategist, defensive. Okay, in the end, I don't know how many rounds they run. I think it was maximum, but I'm not sure about boxing. But again, Floyd's strength being 46-0, meaning he's never lost a single fight. His claim to fame was entirely that, defense. And then when he saw the opportunity, he jabbed or he punched or whatever. He took it. And in taking it, it added to the points. Very few, less knockouts, less glamour, wow. But consistency, strategy, and it paid. Trading, not like boxing, but sometimes it feels like boxing because you cannot. I mean, you cannot box most of the time actually. I mean, I know this because I feel it. I mean, but when you go back, you think, it's me. And I can tell you, and this is something which I want to tell you, whenever I'm in a loss situation, okay, I get really, really, and I'm holding the position, I get really, really stressed, okay? But every time, however much money I lose, or more money I lose, whenever I sell them or cut, decide to get out, okay, I always feel better. I always feel better because all of a sudden, I have clarity already. Because I'm not being swayed by greed and fear. And I can objectively say, why did I do that? Just like I can sometimes, when I'm not in a position, I see a friend doing something like this, I can tell him, why did you do that? All of you who have traded or invested even, I can almost guarantee you have gone through that cycle. Okay, so the psychology of risk, I think, is more important than all the technical things I can show you or show you later or whatever. Okay. Now, let's focus on capital preservation. How do you do that? Basically, I'm just going to breeze through this because I'm not sure timing and wise. I mean, basically, know your risk profile. How are they aligned to your trading objectives? And does your plan accommodate the two? I mean, do they match? Just an example also, okay? Know yourself. Are you an investor or a trader or a gambler? Okay? Let me just talk a bit about this, okay? I don't gamble, I trade. Let's look at this, okay? This is another friend of mine, okay? His name is Bob. Bob, average guy around my age, you know, he's a professional, reasonably successful. He's got nothing great, nothing, too bad, middle income. He likes to trade because he trades everything. He trades stocks, he trades, I think, currencies also, okay? So the other day he was asking me, okay, no, not the other day, I think sometime, a couple of months ago, I mean, he wanted to buy this Noble, okay? And I'm sorry to bring this example, just an example, okay? He wanted to put, he put 20,000 in Noble. Basically, it was around $1 because he had just come down from broken 108, came down to that level. He thought, because there were some reports in the market, and he studied them. I mean, we didn't know anything. So, fine. So, I asked him his plan, okay? The targets out there about 150 and above. He's buying here because he said 130 he's going to get out. Same thing, his plan was almost closer to Alex. Basically, he's looking at 3 times, 1 time, his cut loss was 90 cents. Okay? Today, he's still holding Noble. It's below that, it's around 83 cents or so. Now, Noble can be 150, okay? But what I'm saying is that the plan was there, he didn't follow that. Because his threshold, 20,000, 10%, he was going to lose $2,000, that's all. Okay? But it's now more than that now. I asked him, so what are you going to do? Okay? The interesting thing is that he sometimes go to casino also. I mean, who goes to casino here? Or who doesn't go casino down here? Nobody want to put up their hand. Okay. But anyway, very simple. I'm not sure. I mean, I haven't been, but I know a lot of people who goes, a few friends who goes, and their strategy is very simple. I mean, they're not gamblers or traders in big way. I mean, it's just for fun. They say, I bring $2,000, I go down there, if I lose, I walk out. Very often that happens. I mean, there are a lot of dangers also. Some people go out and they'll, get more money and all. But that's, okay. But generally, most people, 2,000, for the fun of it, 6 hours or 3 hours can last, or you can last more, they'll last more, okay? But in their mind, they're going down there knowing that they're going to lose that $2,000 already. Okay? Bob, okay, he does the same thing. But in trading, when he tells himself, I'm going to lose 2,000, everything else comes into his mind when he hit the 2,000 stop loss level. The broker may say, okay, it's not 180, it's now 120, You say, oh, okay, well, now 90 cents, 80 cents, 120 still got a lot of meat. All of a sudden that number comes into his mind. And he's not satisfied. He become one, to sell. So, at the end, I think his risk control, okay, in gambling is better than trading. Then I trade. I don't trade, I invest. So I ask him now, what are you going to do in Noble? He said, what to do? Hold long. Because it's investment, long-term one. Because he said, I already pick up. Okay? These are all things that you bring to yourself. Because he didn't go into this because he wanted to buy and pick up for the long term. It was totally different. He wanted because he thought there was a shot that was going to rebound and rebound very soon. Okay? Now, that episode is still ongoing, but this is just one of many, like I say, examples once more. Okay? So in the end, I'm gambling, I don't gamble, the denial continues. Okay? I mean, these are just extreme examples. Okay, let's look at, first of all, I just threw this chart in just to make it look a bit official. But basically, the key point to stress down here, science, art. In fact, to me, they're both art. Okay? Basically, investment, you think long term. Okay? So long term gives you that ability to ride out that investment plan. I'm a trader. I don't buy a stock if I don't think I'm going to make money today or 1 week, depending on my time frame, my objectives. Right? If somebody comes out and say a report is going to be worth 150, it's now $1, no analyst is going to say it's going to be 150 by the end of June. Nobody asks you to say buy now, because end of June it's going to be 150, it's $1 now. Nobody. They work their numbers, because I know I was in institutional sales, which means I market these analysts to institutions, big institutions, funds basically. Okay, so when so the thing is, investment gives you a long-term ability to ride out cycles. Okay, and I think I've got a colleague later speaking about a fellow speaker talking about ETFs. I mean, investment. That's what I do sometimes, because I got a 2-3 years objective for those investments. I buy ETFs, I buy funds. Okay, I put it aside. Every 6 months I review it. But when I get a tip from the papers, or I get a view, or I think, oh, it's trading for me. Very clear. Okay, Bob, gamble, become trade, become long-term investment. Okay. I'm just trying to draw that distinction. Okay. The other thing is, obviously they use fundamental analysis, use more technical analysis. Positions, many long portfolio-based diversification. As a trader, I don't like diversification. Okay, this is totally against what I think most of you have seen, learned, understand. Don't get me wrong, diversification is key. Okay, but I cannot diversify my portfolio like Warren Buffett. Okay, so I let the experts do. ETF or fund manager, I dump it there. I let them diversify. I like that category of that region of the world to invest, the asset class to invest for 2 years, 3 years, because this is a cycle. I put it there. But when like I say, I get a tip, or this thing looks good, or oil is rebounding, maybe this thing will move. I think of it as trading, and I set my parameters, and I work around them. Okay, I don't diversify because, and this is me. I'm not saying that everybody should do this. I don't diversify because I don't want to have, like another friend of mine, I won't say his name, but I've got many friends, okay? He's losing this position, he went in for a trade, but he said, never mind, the other side making money. Okay? Because at the end of it all, the other side has nothing to do with this. And why you went into this. Okay? So this is exactly what I'm referring to, At the end of the day, I keep stressing this, do they match? And I think it's very important for them to do so. Now, I just want to go through a few simple strategies, okay? Everybody know about stop loss. I mean, this is something which I need to put up just to make sure that everybody, has an idea. Anybody don't know what stop loss means? Okay, everybody knows, huh? Okay, stop loss is the time where you think your $2,000 in the casino is out. Okay, it's finished. Enough. Okay? But the problem is, are supposed to take emotional trading. But sometimes, like my friend Alex, like my friend Bob, it passed their stop loss level. And they just don't do it. Okay? My simple strategy is, if you fail to commit, because the commitment part is the biggest part, then automate it. There are some certain systems, okay, that we have. We as in my company, within our execution platform, okay? But the bottom line is, these are all technical terms, standard stop loss, trailing stop loss, guaranteed stop loss. They're all same thing, how to get you out of trouble. But like I say at the very start, it's you that's going to get yourself out of trouble. If you cannot, automate the thing. That means at the start, plan, execute it. The other thing I want to introduce is time stop. Because I'm a trader, I look at it from a time point of view. Why do I buy this stock? Or why do I buy this market? Or why do I short this currency? Because I want to make money. And I think I can make money now. Because of this I think is going to happen. Maybe not now, maybe not today, maybe in 1 week's time, or maybe in 2 weeks' time. But I set myself a time. Because sometimes people see a value trap. Value trap means, like I showed you the very first slide about China Airlines, the Chinese, they were flat, but the value was there. But when it moved, that's where you extract the most out of that value. So time stop is something which I encourage quite a bit of. Okay, now I'm just going to go through a series of these technical ideas about how you perhaps can protect. I mean, in times of, and this is something which I think I want to bring our platform into this also. I mean, CMC Markets offer this from a standpoint of being able to do it on a relatively cost-effective basis. Okay, the three examples I'm going to highlight is probably a single stock protection, stock portfolio protection, and simple protection against currency risk. For example, I mean, protecting single positions. I mean, people talk about protecting, they're talking about hedging. Hedging is too narrow a definition. I'm looking at just protecting, okay? Basically involves the trader taking an opposite position to their long-term holdings, okay? And the example is very simple. For example, you have CapitaLand shares you bought in the CDP. That's for investment because you want to give it to your kids, your grandkids, or whatever. You look at it 5 years because the 5 years plan or 10-year plan is wonderful for the company, their growth in Asia and whatever, okay? So the thing is, but you know that now things are a bit low, a bit volatile because of this happening, the FOMC, so on and so forth. Okay, so you want to protect that. You've got a gain. This example has a gain. Basically, you bought 10,000 shares at 250. You have a gain of around 12,005. 12,005. Sorry, I should have put a better example because the price today or the price the last couple of days was around 370 something. Okay. And maybe this slide will give you better. It was 376, I think 2 days ago. I think it's come down a bit. Okay, so again, just to you bought at 250 in your CDP, you don't want to sell because is there long term? Okay, but you want to lock in your paper profits. What you can do is to hedge your position against a CFD position at 376. What this means is that you short 10,000 shares, or 10,000 CFDs of CapitaLand, and you short it at this price. Now, what happens is that if the stock drops to 366, your CPF position, you will lose $1,000 back because why? The value is 10 cents lower of 10,000 shares. But your CFD position will make you $1,000, which means that your original 12,006 is locked in. Okay? Vice versa, if CapitaLand goes up, okay, which is not what you're thinking of, you still, your position, your CPF will gain. And your CFD position will be lost, but your profits are more or less locked. Okay? The key point is this. I'm so sorry about this slide, but what this means is estimate margin. Just now, I think one of our fellow speakers from SGX, he was saying it's 100 times gearing. No, I mean CFDs for stocks, the gearing is 10 times, 10%. So basically, to sell 10,000 shares of CFDs at 376, your margin requirement is $3,765. The estimated cost, which is the brokerage or whatever, is $37. So the point being, you're using about $3,800 to protect yourself, okay? And you don't care whether the market is going to go up because Mrs. Yellen is going to do something totally unexpected or what. But at least and these are all taking away costs for the. I mean, the example was just to take away all the costs for the stamp duty, the commission, so on and so forth. But I'm just trying to explain and talk about the rationale behind this. Okay. The next thing is against indices. For example, if you have a portfolio of shares. Some UOB, some DBS, some CapitaLand, some Capital Corp.